I am MRS.S.SHANTHI, Assistant Professor of Commerce, A.D.M.COLLEGE, Autonomous, Nagapattinam. Today, we are going to discuss about the first unit of the principles of accountancy. So, first one, we have to see the meaning and need for accounting. A businessman invests capital with the objective of making the profit. He incurs the various expenses like salaries and rent and other expenses to operate his business activities. He receives income from different sources like interest, commission and discount. He deals with several persons for buying and selling of. He acquires various properties like building, machinery, furniture in order to generate the revenue. All these activities should be properly recorded. Then this method of recording is called accounting. The definition of accounting. Accounting is the art of recording, classifying and summarizing in a significant manner in terms of money transactions and events which are of a financial character and interpreting the results thereof. So with this definition, we can see the characters and steps of accounting. The first character is recording of all the transactions. Then second one is the classification. Classification is according to the nature of activities, we have to classify the transactions. Then summarizing. Summarizing is grouping according to their nature. Then significant manner. In a routine manner, we have to give the importance to each and every activity. The next one, in terms of money. Business is mostly in connection with the money transactions. So, in terms of money transactions. The next one, the transactions and events of a financial character. As a business activity, the businessman must have the various events which are having the financial character only. And last one, interpreting the results. According to the various activities and nature, we have to classify and we have to find out the results. So, this is the interpreting the results. Then next one, we have to see the objectives of accounting. The first and foremost objective of any accounting is to find out the profit. So, first one, maintenance of accounting records. As a businessman, he has to maintain the various records which is available in the concern. Then second one, ascertainment of profit or loss. As a good businessman, he has to find out the profit or loss which is available in the business. Then only he can have the good image of their business activity. Then depiction of the financial position. The financial position must be find out by the person. Then last one, providing information. The information which is available in the accounting records must be exhibited to the government, then the financial institutions and other public. So this is the providing information to various third parties. The next one, the advantages of accounting. There are so many advantages of accounting is possible. Number one, the systematic records. Systematic records is the business activities must be systematically recorded by the businessman. Then preparation of financial statements. Preparation of financial statements like the trading account, profit and loss account and balance sheet. Then assessment of progress. The progress of every business activity must be assessed by the businessman. The statutory requirement. Statutory requirement is nothing but every company must satisfy the government and also the other financial institutions, bankers, etc. In order to satisfy this one, they have to prepare the accounts. Then aid to decision making. Aid to decision making is nothing but as a businessman must prepare their accounts in order to take the correct decisions at the correct time. Then information to interested groups. The information should be provided to all the public and also all the persons who are interested in their company. Then evidence in court. The profit and loss account, balance sheet and the other trading account is a good evidence. And taxation problems. The taxation problems can be solved by the accounting records. Then merger of firms. In the case of merger of firms, as a company must give their own record. And next we have to see the limitations of accounting. The limitations of accounting is only some points. It cannot record all the events and transactions taking place in the enterprise. A businessman cannot able to record all the events and transactions taken place in the enterprise because it has to concentrate in various matters. Next one, it cannot quantify the morale of employees. The morale of employees is a must for every company. The morale of employees must be maintained and should be kept up by the company. But in some cases only, it is a rare cases only, the morale of employees cannot be quantified. Then it is in need of technical knowledge. As a good businessman, he has to be in need of a good knowledge and the technical persons to prepare their accounts. In the case of lack of technical knowledge, it will create some problems. The last one, it is in need of a lot of paperwork. Paperwork is the must for the company account. The next one, we have to see the branches of accounting. The branches of accounting is classified into three. First one, financial accounting. Second one, the cost accounting. And third one, management accounting. The financial accounting is mostly followed by the companies, those who are interested in the production of various products and selling their products. So in the case, they have to find out the gross profit, net profit, and they have to find out their actual financial position. So for this case, they have to follow the financial accounting method. Then second one is the cost accounting. The cost accounting method is mostly followed by the companies, those who are engaged in the manufacture or production of commodities, because they have to find out the cost per unit of the products. So they are following the cost accounting. Then management accounting. Management accounting is followed by the companies when they have to take the decisions in the correct time. So these are the three branches of accounting. The next one, methods of accounting. There are two foremost methods of accounting is possible. Number one is single entry system. Then second one is the double entry system. Single entry system. It is followed by small scale business firms. There are two methods are possible, net worth method and a conversion method. Single entry system is mostly followed by the small scale business houses. In this case, they have to take the opening stock, opening balance of the company, then closing balance of the company, and they have to concentrate about the any drawings which is available in the business, and also they have to concentrate about the additional capital introduced by the person. So this is the single entry system. In the single entry system, they have to concentrate the opening capital, then closing capital, and also additional capital, and if there is any drawings. The next one, the double entry system. The double entry system, it is followed by the large scale business houses. Every transaction is having the dual aspect, that is, one aspect is the debit aspect and another one is the credit aspect. So we are call it as the double entry system. With the double entry system only, we have to prepare the various accounts, just like the journal entries, then ledger accounts, then trial balance, and also the balance sheets of the company. So this is called as the double entry system. Then now we have to see the advantages of double entry system. There are so many advantages derived from the double entry system. Number one is a complete record is possible. Number two, the ascertainment of profit and loss account is easy. The knowledge of the financial position is derived by the company accounts. Then fourth one, a check on the accuracy of accounts. The accuracy of accounts may be derived only by the double entry system. Then no scope for fraud. There are so many opportunities for fraud. When the company is having a proper double entry system, there is no scope for fraud. The next one, tax authorities. The tax authorities can be satisfied only when the company is having the double entry system, and according to that, they have to prepare their own accounts. The amount due from the customers. Amount due from customers and amount due to suppliers may be easily find out when the companies are having their double entry system, because in the suppliers are available and it should be posted in the liability side, and the customers, that is the debtors can be posted in the asset side. So the amount due from the customers and the amount due to suppliers may be easily find out by the person. Next one, comparative study. Comparative study may be easily prepared by the firm. When the company is having so many competitors, there is a possibility of comparative study. Then only they will have the good comparisons and they will have the good competitors. So these are the advantages of double entries. The next one, the types and rules of accounting. The rules of double entry system is otherwise called as the golden rules of accounting. There are 3 rules are possible: personal accounts, real accounts and nominal accounts. Personal accounts are mainly in connection with the individual parties. So that the rule is debit the receiver and credit the giver. So the receivers are debited by the person and credit the giver is the persons who are giving any aspect or any articles to the company, they will be under the credit side. So personal account rule is debit the receiver, credit the giver. Then second rule is the real account. Real accounts are mainly in connection with the assets of the company. So we can have the rule is debit what comes in and credit what goes out. Debit all the items or the assets which are coming into the business, and we have to credit the various items or the articles which are going out of the business. So the second rule is real accounts. So real account rule is debit what comes in and credit what goes out. Then third one is nominal account. Nominal account is generally all as a company is having the so many expenses and also the incomes. So the third rule is debit all the expenses and losses, credit all the incomes and gains. So the expenses are just like the rent, salary, then any insurance, then taxes, any activities. So we have to debit all the expenses and losses and credit all the incomes and gains. Incomes are just like the interest received, commission received, any items which are received by the company. So there are 3 types of accounting. First one, personal account. Second one, real account. Third one, nominal account. Personal account rule is debit the receiver, credit the giver. Real account rule is debit what comes in, credit what goes out. Third one, nominal account rule is debit all the expenses and losses, credit all the incomes and gains. Then we have to pass on the accounting concept and convention. First, what is meant by accounting concept? Accounting concepts are the assumptions or ideas which are essential to the practice of accounting and presentation of financial statements. There are so many accounting concepts are available. First one, the business entity concept. Second, going concern concept, money measurement concept, dual aspect concept, accounting period concept, cost concept and matching concept. Now we can see the meaning and the explanations regarding the accounting concepts. First one, business entity concept. A business entity is an organization of persons to accomplish an economic goal. According to the entity concept, the entity that represents the association of persons is considered distinct and separate from owners, managers and employees of the enterprise. Then next, the going concern concept. According to the International Accounting Standards, that is Accounting Standards 1, the enterprise is normally viewed as a going concern, that is, as continuing its operation for the foreseeable future. It is assumed that the enterprise has neither the intention nor the necessary liquidation. So that is the going concern concept. Next, the money measurement concept. All business transactions are measured, expressed and recorded in terms of money. Money provides a common denominator or unit of measurement by means of which heterogeneous facts about a business can be expressed in terms of quantities which can be added or subtracted and summarized. The next one, the dual aspect concept. Every business transaction recorded in the books of accounts of a business has 2 aspects, receiving of benefit and giving of benefit. Both the aspects of each transaction must be recorded in appropriate accounts of the business. Then accounting period concept or periodicity concept. A businessman and business unit may continue for an indefinite period. It is possible to ascertain overall profit or loss of the business which it is liquefied, but practically it is not possible to wait for an indefinite period. The next, the cost concept. Accounting is a historical record of the transactions of a business entity. According to cost concept, assets are recorded at the price paid to acquire them. This cost is the basis for all subsequent accounting for the assets. Then matching concept. So matching concept is the primary objective of commercial enterprise is profit making. The accountants are responsible to match the revenues earned during the accounting period with the cost associated with the period to ascertain the profit earned. Matching of revenues and cost relevant to the specific period is called the matching concept. Then accounting conventions. What do you mean by accounting convention? According to this convention, all accounting statements should be prepared honestly. This should be transparency of the statements. The statements should disclose fully all the significant information. The convention of disclosure is gaining importance due to the shift in the growth of a business organization. The detailed form of schedules are prescribed by the Act. Then we can see some important terms in the accounts. First, we have to see what is meant by journal. Journal is the book of original entry. All the transactions are initially recorded in the journal. The ruling of the journal is such that any business transaction can be analyzed under the heads of debit and credit. So, journal is the book of original entry. It is just like the rough cash book of the company. Then next, ledger. Ledger is the main book of accounts of business. In this stage of accounting cycle, all recorded business transactions are grouped on a three-determined basis. Such grouping takes the form of accounts in a separate book named as the ledger. Then capital. What is meant by capital? It is represents the owner's funds invested in a business. It may be the original amount invested by the owner or original contribution adjusted for profits and drawings. Then liability. What is liability? Liabilities are the debts. They are of a business. In the words of Finney and Miller, they are the amounts owed to creditors. Then assets. Assets are the future economic benefits, the rights which are owned or controlled by an organization or individuals. Then revenue. It is defined as the inflow of assets which results in an increase in the owner's equity. Expense. It is any amount spent in order to produce and sell the goods and services which bring in the revenue. The debtors. Who are the debtors? A person who receives the benefit without giving money or money's worth immediately, but liable to pay in future is a debtor. So, debtor can be a trade creditor, trade debtor if he buys goods on credit. So, the debtors are the persons who are the company is having the responsibility to receive the amount from the debtors. So, the debtors amount is mostly available in the asset side of the balance sheet. Then creditors. A person who gives benefit without receiving money or money's worth immediately but liable to claim in future is a creditor. Creditor can be a trade creditor if he supplies goods on credit. Tangible assets. Assets which have the physical existence. That is, they can be seen or felt or touched as termed as the tangible assets. Intangible assets. Assets which have no physical existence. That is, they cannot be seen or felt or touched are termed as intangible assets. For example, goodwill, patent right, copyright, etc. Then fictitious assets. Items shown along with the other assets on the asset side of the balance sheet. For example, preliminary expenses, profit and loss account. Then wasting assets. Those assets which certainly lose value with the usage are termed as the wasting assets. For example, mines, forests, etc. Then fixed assets. Assets acquired for income generation and not for the resale. The benefit from them is derived for a longer period. For example, machineries, land and building. Then current assets. Current assets are these assets which are converted into cash in normal course of business. When the company is in need of money, the company can sell the assets, sorry, a stock which is available in the company. So it is called as the current asset. For example, stock and debtors. Then purchases, buying of goods for resale purpose. Sales, selling of goods in the normal course of the stock. It refers to lying goods unsold on a particular date. Loss, it indicates something against which a firm receives no benefit. Goods, the commodities bought for resale purpose. Insolvent, a person whose liabilities are more than the realizable value of his asset. Then there are some differences between the journal and ledger. There are so many points in connection with the differences between the journal and ledger. The first and foremost point is the primacy. In the case of journal, it is the book of original entry, but in the case of ledger, it is dependent on journal for data. Then recording. In the case of journal, recording is in chronological order, but in the case of ledger, no specific order for ledger. Then evidence in value. Journal has better evidence value, but ledger is the primary source for the results. Then focus. In the case of journal, journal focus debit and credit aspects, but in the case of ledger, the ledger focus is on account. Then importance. Journal is a subsidiary aspect. The ledger is the main book of accounts. Then timing. Journalizing is a continuous process, but ledger can be done at any time. So these are the differences between the journal and the ledger. The subsidiary books. Subsidiary books. The subsidiary books are those books which can be prepared by the businessman in order to find out the total credit purchases and the total credit sales. So the meaning is, to find out the total credit sales and credit purchases, the businessman has to prepare the subsidiary books. There are some types of subsidiary books. There are the first one, the purchase book. Second is the sales book. Third one, the purchase returns book. And fourth one, sales return book. Then we have to see what is a trial balance. So trial balance is a statement containing the balances of all ledger accounts as at any given date, arranged in the form of debit and credit columns, placed side by side and prepared with the object of checking the arithmetical accuracy of ledger posting. So trial balance is prepared by the businessman in order to find out the arithmetical accuracy. There are two methods can be followed. First method, the total method. Second one, the balance method. Then now we can pass on to the unit 2, which is having the final accounts. So final accounts is the primary function of accounting is to find out the profitability of the concern. In order to find out the profit, they have to prepare the final accounts. The preparation of final accounts is the last step in the accounting cycle. So there are 3 stages of accounting. So first one, the trading account. Second one, the profit and loss account. And third stage is the balance sheet. In the first stage, we have to find out the gross profit. Then in the second stage, we have to find out the net profit. And in the balance sheet, the assets and liabilities should be tallied. Then preparation of the steps for the preparation of trading accounts. Items appearing on the debit side of trading account: opening stock, purchases, purchase returns or the return outwards, then direct expense, all the direct expense. Then in the credit side, the sales value, then sales returns, then closing stock. Profit and loss account. It is an account which all gains or losses are collected in order to find out the net profit. So in the case of profit and loss account, we can derive the net profit. Then items appearing on the debit side of profit and loss account: all the operating expenses and all the non-operating expenses. Then items appearing on the credit side of profit and loss account. In the credit side of profit and loss account, first we have to put the gross profit. Then in the credit side, we have to put the operating income and non-operating income. Then balance sheet. It is a summary of balances remaining open in general ledger. It shows the financial position of the business. The capital and liabilities of the business are shown on the left hand side, and assets and other debit balances are shown in the right hand side. The balance sheet is prepared with a view to measure the correct financial position of the business on a fixed date. Therefore, it is rightly called as a mirror of the business, which are in the business we can see its face, that is its true position. So therefore, it is the rightly called as the mirror of the business. Thank you.